Good morning, ladies and gents, and welcome to the May 2026 edition of the Blackfinch 10-minute market forecast. Thank you for joining us. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management, and joining me today from the Blackfinch investment team is Assistant Portfolio Manager, Mr. Josh Clayton. For those joining us for the first time, we use this webinar to run through what we believe to be some of the most important events occurring across the globe shaping markets, providing our views on the effect they've had, an outlook of what we expect to come, and as a result, how we're positioning our portfolios. If at any point you have questions on today's content, please submit them using the Q&A box, or we will be providing our contact details to reach us directly at the end of this morning's session. Now, before we begin today's content, I would like to note that the detail we cover is intended for financial professionals only, and that it shouldn't be interpreted or taken as financial advice. Today, we have three items to cover for you. First, we look to the ever-evolving situation with the Strait of Hormuz and the oil shock that's feeding into the global economy. Second, we'll explore the momentum in Taiwan and the link between US hyperscalers. And finally, we'll be reviewing the emerging market space and the indicators that reinforce the investment case for the area. With that said, I'll now hand over to Josh to get started with today's content. Good morning, Josh.
Morning, Jordan, and good morning, everyone. So Jordan's kind of listed it off already. There's three key areas I want to focus on: this oil shock, Taiwan, and the broader emerging market opportunity. And I think the key message is that while geopolitical risk has clearly risen, the underlying investment case behind our positioning is very much intact. You know, we're asset allocators, we have a long-term investment horizon, and the portfolios are constructed with exactly that long-term diversification in mind. And we do believe the current asset mix remains well placed through this moment in time. So let's start with where we're on the conflict, and more specifically oil. It has seen a lot of volatility of late. It's become very evident we're in this new regime of negative supply shocks, higher inflation volatility. And we've seen this oil price kind of whipsaw back and forth as markets are really trying to assess whether this is a short-term shock or something more persistent. And tensions in the Middle East could well escalate again in the near term, but we do think the hit to global economic growth could be contained. But as always, certainly have to be humble when we're making these forecasts, as events are moving very fast. But as we've started to see in the data, the issue isn't just the oil price, it's more the knock-on effect to things like inflation expectations, central bank policy, bond yields, and consumer confidence. Higher energy prices effectively act like a tax on households and businesses. They're going to squeeze your real incomes, they'll raise input costs, and it will make it harder for central banks to confidently cut interest rates. And so far, the economic activity declining appears manageable, but the situation certainly isn't over. If this disruption does continue, especially around the supply routes, as Jordan said, the risk is that this inflation volatility remains higher for longer. It is a tail risk in investment returns. For the most part, previously, investors have been pricing in a more benign backdrop, a lower inflation, easier monetary policy, and pretty resilient growth. A sustained shock challenges that. And then it's worth us talking on the political angle too. And if we bring in the slide, if you've seen my previous webinars, I've talked around the WTI oil price, which stands for West Texas Instruments and supplies the US market. And if we look at that top chart, what's interesting here is the disconnect between oil and what consumers are actually paying. So while WTI remains below the 2008 peak, retail fuel prices are already back at similar levels. And that's largely because pump prices are driven by more than just oil. There's refining capacity that's pretty constrained. Margins are elevated, and the distribution and the tax costs are structurally higher than what they were kind of pre-2008. And the result is that today's fuel prices in the US feel equivalent to a much higher oil price environment, so closer to 140, 150 per barrel for in real terms for US consumers. And we already know that lower income consumers are feeling a squeeze. And all of this creates a pretty perfect storm against Trump for the upcoming midterms later in the year. So with this fast approaching, US fuel prices could be this meaningful headwind for Trump if Republicans lose control of the House and potentially face some pressure in the Senate. that would reduce Trump's room for maneuver on future actions, and especially for markets, from our perspective, could be a net positive. Less political power means fewer levers to pull, less scope for aggressive policy shifts, and potentially a lower probability for this inflationary volatility or further fiscal expansion or geopolitical escalation. So for us and the team here at Blackfinch, the message is balanced. Of course, this oil shock still remains a real risk. We're watching it closely. But ultimately, if this weakens Trump's political control, that could reduce some of the medium-term risks that we've been talking about over these webinars. So if we move on to Taiwan, it's been a meaningful position for us across the portfolios for the past year or so. Our weighting to the country is largely centered around this global AI build out. It's one of the clearest picks and shovels plays for us as asset allocators. In our view, we don't believe anyone truly has the secret formula to picking out which company is going to be the winner in this AI race. So what we prefer to do is just allocate to the engine, the infrastructure behind the technology. And I think the most obvious examples, Taiwan Semiconductor, it sits at the heart of this global semiconductor supply chain, and it almost commands near monopoly levels of market share for semiconductors. They recently raised their 2026 revenue outlook. They're expecting revenue growth of more than 30%. They indicated capital spending should go to the upper bound of its 56 bill guidance range. And it has something like a near 58% surge in profit. And all of this is underpinned by this resilient AI demand. And I think the important point is this was mid-April, so despite all the concerns around the Middle East conflict. So to me, that just tells us that even with this uncertainty, the demand certainly hasn't disappeared. If anything, hyperscaler spending plans continue to move higher. We're going through US earnings seasons at the moment, very robust figures, some good earnings surprise from some companies. So they're certainly geared up. They're financially ready to commit more capital. And this is what the chart's showing. This is just forecasts for US hyperscaler capex. It's been revised up materially, and the consensus outlook still points to this level of spending over the coming years. That's a direct benefit to Taiwan as that dominant supplier. They're well placed to capture the demand, and this is really why we're maintaining our conviction in the region. The other part to this is valuation. The story hasn't become detached from fundamentals. We've talked about earnings improving and expectations being upgraded, and that capex cycle being supportive. So while Taiwan has performed strongly and has been a bit of a bull case for us here at Blackfinch, we don't think the case is exhausted. And this certainly will be a theme you see evident over the coming months, again, unless there's a material change to the investment case. And that takes us to the wider emerging market position. We can talk about valuation again. Compared with US tech, Asian tech is meaningfully cheaper. You can access similar long-term structural growth drivers, but at a much lower valuation. And that helps just avoid some of the common pitfalls with a highly allocated and momentum-driven market in the West. And just to continue this point on the AI story, the other side is AI adoption in emerging markets. It isn't just a US story. It feels like a long time ago, but if you remember January 2025, we had the announcement of the Chinese AI developers DeepSeek. They were this direct competitor to the West. And at the time, the physical tech was quite archaic. The US certainly did knock spots off it, but as things have progressed, we've seen the release of more efficient models that leaps and bounds of that original launch. They have very strong efficiency and processing capabilities, which shows that the AI race is becoming more competitive. It's becoming more global. It's probably worth saying it's unlikely we ever see it break the Western market. So they'll stay in their lane, but even that lane has nearly 1.1 to 1.2 billion people in the market alone. So a long runway for earnings growth. If we then just view the emerging markets through the economic lens, it's still very much an attractive case in our view. What we're looking at is the diffusion index on the screen. This basically just takes a group of companies in a basket. It checks the data for those countries that makes up the index and then calculates and weights the percentage to those that would reflect a rise and fall. And what we can see is the manufacturing activity indicators across emerging markets have remained very resilient. And we're comparing that then to EM equity returns. And we're seeing this positive relationship between the two. And I think that's important because this is even after the oil price spike. The broader activity certainly hasn't collapsed. The latest data suggests that the emerging markets has entered this period from a position of relative strength. There are risks. Higher energy prices can certainly hurt household spending. It can raise costs for businesses, create some second round effects. But I think the key point is on aggregate, the EM earnings picture is strong, especially from the things we've been reviewing. We're seeing expectations move higher, and we're still looking through a very attractive valuation lens for the emerging markets. And I think it's probably important to say at this point that we're advocating active management in the space where we can to further enhance those returns and just pick out some common traps in the region. Um, at the same time, we certainly don't want to be complacent. We're very humble to the level of volatility in markets at the moment. Oil prices are still volatile. We're seeing it all over the news. And that means your inflation expectations can move quickly, and so can central bank expectations. They can shift again if energy shocks prove more persistent. So we believe that our portfolios are well diversified to weather much of this, but we're very ready to act if the investment case deteriorates. It's worth probably gently touching on bond duration. Bond markets can behave very differently depending on whether investors are focused on inflation or recession risk. Shorter duration exposure can help sensitivity to inflation shocks, while broader fixed income and alternative assets can help if we're seeing kind of growth weakens. But across the portfolios, the aim is not to just pull one single lever. We really do want the various parts of the portfolio to perform at different points in the cycle. Equities for long-term growth, fixed income for income and resilience, and alternatives for diversification where the traditional assets are falling foul and being more correlated at the moment. So in summary, while the conflict's driving short-term volatility through oil and inflation expectations could reduce US political control if Trump struggles at the midterms, that could ease some risks over time. And at the same time, Taiwan and emerging markets continue to show some very strong earnings momentum, and that supports our conviction in the positioning. So I think that's everything from me, Jordan. I'll pass back to you for the wrap up. Thank you, everyone.
Thank you very much, Josh, and thank you everyone for spending your morning with us. Now, as promised, you'll find our details on screen now, and we certainly encourage you to reach out if you have any questions on today's content, if you like any comments on events that perhaps we didn't cover, or of course, if you'd like to hear about how we can support you with your CIP, CRPs, or indeed with our managed and tailored portfolio services. But we do hope you'll join us for our next instalment. That's due to take place on Tuesday, the 2nd of June, at the same time of 8:50 a.m. But for now, from all of us here at Blackfinch Group, we'd like to wish you a pleasant morning and look forward to speaking with you soon. Bye for now.